Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Each and every week, we bring in special guests, talk about the markets, how they relate to currencies, currency options. Today, I'm really happy that we have John Person with us. John is the founder of NationalFutures.com. John spent many years on the floor of the exchange, battling it out as I did.
This is obviously my work. It's obviously something that is for educational in purpose, and also just wanted to make sure double duty as far as disclaimers are concerned. Past performance is not indicative of future results. The CFTC and the SEC and all these regulatory bodies that govern us really want to make sure that we put out these disclaimers for your protection and benefit as well.
Hey, John. Can I just jump in real fast?
Please do, Steve.
I just want to remind everyone that this is John Person, and John is talking about using technical analysis to develop an FX option strategy. I'm your host, Steve Meisinger. Just want to remind everyone, I think the recorder hadn't been turned on. So again, this is John Person, and he'll be talking about using technical analysis to develop an FX option strategy. I'm your host, Steve Meisinger. Sorry about that, John. Please move forward.
No problem. And folks, because it's being recorded, not TiVoed, but any event, we seem to have a few disclaimers up, and that's okay. Folks, welcome to today's session, and it's certainly my pleasure to work with the ISE, especially Steve Meisinger, really good guy, and many of you are probably familiar with his work in it of itself. He does a lot of presentations, does a lot of hard work, helping to educate the investing public. And from what I see and talk with and hear from people respond to me by email and some of their trades, I would say that the general public is doing quite a lot better than they were, say, maybe even 5 or 6 years ago. And I think it must be through better understanding and better education, taking control of their own trades. And you know, positive results-driven traders, you know, we are not like weathermen where we can call the weather bad and still, you know, have a job the next day. We're results-driven people. We need to show consistent profits, otherwise, you know, there's no sense in trading. And I think that for people to come here, they are seeing success and they are intrigued in the other opportunities. And so that's why I'm very proud to be a part of the ISE's educational presentations. And we've done some really good presentations in the past. And if you just logged in, this is being recorded. Just wanted to mention that. And also, we've done some past presentations to talk about seasonalities, candles, pivots. And I think we've had some really good moves in the marketplace based on seasonalities. And I thought it'd be nice to today to come back and say, listen, besides looking at the seasonalities of some of these currency plays, look at some of the technical indicators that most people are familiar with that may give them an edge and help them with their execution, or at least helping them to decide what side of the market to be on. And that's what today's presentation is designed for, to help the investors look at a few of these technical indicators that are most popular and which ones out there are a little bit better, and how I use them personally to get trade ideas and discover opportunities. Now, in the marketplace, every one of us, we all have these 4 common denominators, and we all have equal access to these 4 common denominators, and they are the high, the low, the close, and the open. And every form of technical analysis, every indicator, oscillator depend on these 4 common denominators. Generally speaking, an indicator will measure the current bar's close or current bar's price as it relates to past price action. And the past price action, folks, is defined by old highs, old lows, closes, and opens. If we see a moving average study, a simple moving average at that, which is designed by taking past closes, for example. If you take a simple moving average based on the close, it will just define and filter out the excess noise, not necessarily the highs and lows or the ranges. It'll give you a value of what the typical price is based on the input that you've generated, whether it's a 10-day moving average, a 20-day, or a 200-day moving average, in fact. So most traders are using technical analysis without understanding where those indicators or how those indicators are derived. And I think it's interesting, if you think about it, really, if we all have equal access to these four common denominators, then how come all of us have different results? And it's how we understand, relate, and then more importantly, react to the information presented to us. That's what makes us different as traders. We all have equal access to this information, and again, it's how we interpret and act on this information that makes us better or worse than the next guy or girl. Our job as a trader is to look for setups and triggers that depend on the current market condition, or at least the last price, the close, as it relates to these past four or current common denominators. And I say current because where is the close as it relates to the current bar's high and low? Where is the close as it relates to the average of past 5 periods highs or average past 5 period lows? I gave that example because, quite frankly, that is a moving average channel that people can utilize. Instead of using a moving average of closes, we can utilize these parameters even in understanding moving average parameter values. So instead of taking a close of a moving average, we can take a moving average of highs or a moving average of lows. Tell me what the average of the past 5 periods high was, and if the market closes above that, then we have a true momentum, kind of like our own momentum reading, and we call that a moving average channel. And that's something that each and every one of you, if you have a trading account, you have a platform, you could simply change the parameters of a moving average. No one told you that you had to just use a moving average of the close. It depends, and that's what we're going to discover today together. It all depends on what you're expecting and what you're trying to get out of the indicator and what you're trying to uncover. If you're trying to uncover a bullish momentum breakout, then maybe it would behoove us to examine more closely a moving average high channel value. If we're trying to look for a particular support that may break down and show us that we have a negative momentum or a bearish breakdown in price, then perhaps using a moving average of the lows as a support violation technique would be better for us than, say, a moving average of the closes. So there are many different ways that we can, at the very simplest place, use these values to change the parameters that we're currently using in our technical analysis techniques.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.